Good evening. Good evening. Thank you for joining us tonight for Tusk's second webinar of the year. Tonight, we are going to be talking about preparing your business for sale. If you are 1 year, 2 years, 4 years, 8 years away from selling your business, there are some things you must know. The trick here is to pay Uncle Sam as little as possible and to build the most tax efficient structure. So when we're looking to do things like that, we reach out to our friends over at Profit 2020 with help, and they have been kind enough to join us tonight to give us an accounting perspective of transactional work. My name is Kevin Cumbus. I'm president of Tusk Partners, and we are elated to have you here. Tonight, two special guests, Brent Saunier, co-founder and managing partner at Profit 2020, and his partner, Chris Sands, the strategic growth partner and co-founder as well. Gentlemen, thank you both for making time this evening. I really appreciate it.
Hey, thanks, Kevin. We're super excited to be here and so excited to have these important conversations that I think aren't being had often enough for people, thinking beyond just what that sale looks like for them.
Couldn't agree with you more. I think people, I think folks get really, really excited about what's the enterprise value or what's the multiple. And all too often they forget that the lenders need to get paid. Well, they have to get paid. And Uncle Sam needs to get paid if you want to avoid jail time. So these are kind of some of the things we want to make sure everyone is well aware of. Brent, anything else to add?
No, Kevin, we're super excited to be here and we love educating. So thank you very much for the opportunity.
Great. Gentlemen, do you want to talk a little bit about your firm so we can level set on that front before we dig into the content?
Sure. So, we co-founded Profit 2020 with the entrepreneurial dentist in mind, and that has evolved into, the multi-group space and, just the doctors who really want to be more business savvy than they are even clinically savvy. We were fortunate and blessed to go to a lot of events where we met great centers of influence, such as yourself, Kevin. And in the last 5 years, we've actually grown. We made an acquisition ourselves, so we've been in a transaction a couple of times ourselves. In the last, at the end of last year, we actually grew to over 400 dental practices in 43 states, and it's been an interesting ride. I think you and I and Brent all kind of joke behind the scenes on some of the stuff we get to see behind the curtain. And we take it as our professional mission to clean that up for these doctors to achieve their vision of what they want for their career. And ultimately to just be ready. Selfishly, I'll tell people to hold on to their business. It's a great tax shelter, but always be prepared for sale tomorrow. And so we take it as our mission to make these dental practices all very bank ready and investor ready and sale ready at all times. And it's rewarding when we get to see the results and the clients get to give us their feedback on achieving their dream.
Yeah, I having worked with you guys and your clients over time, it's clear you're a partner, right? So there are firms out there that are simply CPA firms that sometimes send monthly financials, rarely send them on time, normally file for extensions on the tax returns and probably get those right. I really view your firm and what you all do as more of a partnership relationship, fractional CFO relationship, strategic partner, and always pushing the client in the right direction, building a business that is built to sell, irrespective of whether or not they ever sell it. And that's frankly why working with your clients is so much fun.
Yeah, it's just fun. We'd like to say we try to go beyond the accounting because it's just fun to work with the business owner to ask them what their goals are, and then to use just the accounting is just data, to use the data to help them make changes in the business, and just to see them evolve and develop is very rewarding.
Awesome. Well, I look forward to learning more from you all over the course of this evening. Before we get started with the content this evening, just want to remind you all there is a Q&A section inside of your browser where you are. Feel free to lob in your questions tonight. As always, we will do our best to get to your questions, assuming we have time at the end of our webinar. But in the event we do not, we will get back to you by the end of the week. Let's see tonight, it's Thursday, maybe give us till Monday to get answers to those questions back to you. So thanks again for joining us, and without further delay, we'll go ahead and get started. So I always like to start these with a quick market update. If you've been reading what we've been putting out recently, or just keeping an ear to the street, you will know that the fourth quarter of 2021 was the busiest quarter of M&A activity we had ever seen in the dental economy. Some of that was because of some COVID deals, some hangover deals that were supposed to close in 2020 and kind of drug into 2021. A lot of that, though, was driven by a sense of urgency to sell in 2021 before the expected tax changes, the increase in long-term capital gains rates came home to roost in 2022. So that I think that drug a lot of transactions, a lot of doctors, a lot of groups that were thinking about selling in 22 or selling in 2023. They said, all right, well, now's the time. We don't want to get walloped by the tax man on this. Let's get our deal done in 2021. As a result, there was a glut of deals that got done. Great news, everybody traded at high valuations. Great news, there are now more buyers in the market than there have been. We personally helped create 3 private equity-backed DSOs by connecting our clients to private equity groups, a success around for all parties involved. But now, here we are in Q1 of 2022, and there are not enough deals in the market to meet buyer demand. We are absolutely in a seller's market. Of the deals we've taken to market since January 1st, we are already seeing offers, LOIs and IOIs, at 1 to 2 turns higher than the valuations that we saw in 2021. So already we're seeing this uptick, and this is simply demand for deals outstripping the supply of opportunities. This will very well likely normalize by the fourth quarter of 2022. We're going to see this for this quarter and next quarter in Q3. It's too early to tell. My crystal ball is too foggy as to what's going to happen to valuations in Q3. But we are certainly in a seller's market today. Anyone who has employees, anybody that's got a window view of the gasoline prices down the way are certainly aware of the rising cost of wages and supplies. We are expecting to see total margin decline somewhere in the order of 5 to 8%. We were on the phone with a dear friend of ours who's in negotiations with a hygienist who came to him with an offer of north of $70 per hour to retain her, because that's what she can get working as an independent contractor in the market that she's in. These price gouging and wage gouging by team members is happening nationwide. There are not enough employees to meet demand. Patients are coming back, workers are going back to work, patient flow is going to be ticking up. Now doctors have to make sure they have the human capital to see those patients. That and gloves are going up, injectables are going up, labs are going up. So, the EBITDA you enjoy today could be materially hampered in the months and years to come. We show this on the table to the right there, looking at a practice with TTM revenue in Q1. Again, this is trailing 12-month revenue of $5 million, EBITDA to millions. It's a 20% EBITDA margin business. Let's just follow that first gray column down. We're not showing any cost increases. This is just valuation today of $1 million of EBITDA. Let's conservatively say that's an 8x multiple. That would create an estimated value of $8 million. Now let's look what could happen 12 months from now. Revenue's the same, EBITDA is the same before we see these cost increases. Cost increases of wages, supplies, and lab totaling about $82,000 drags down the net EBITDA. Right? I'm taking $1 million of EBITDA less than $82,500 to bring me to $917,500. Only a 1.7% decline in EBITDA margin, but we're also know that there are going to be more deals in market in the years to come, in the year to come. So potentially not just a decline in the EBITDA margin or the EBITDA itself, but also a decline in the multiple. Only by half a turn, from 8 times to 7 times, but the net result there from a valuation perspective could be as much as $1.1 million. So something to keep your eye on, something to be thinking about when you're thinking about timing. We all know you can't time the market, but you can make a well-informed decision about when to sell your life's work. So I want to make sure that everyone on the webinar was aware of these comments and what we are seeing. And then from there, really thought this would be a nice jumping off point to bring back our guests. So we had the pleasure of working with a Profi client back in 2021. Chris, do you want to talk about in broad strokes about the client and how you got introduced to the client and the work that you all did with this doctor from 2014 until 2021?
Sure, and I definitely want Brent to chime in because he was a key instrumental part to this. But this was a client that we worked with since 2014, one of the very first early clients we had. Very coachable doctor from day one, knew that she wanted to grow, to have associates and to have multiple locations, and just wanted to be really, good with her money. And so much so that well before she ever, sold her practice, she paid off all of her debt.
Wow.
And she just a great, student, if you will, of the financial game that we were just, fortunate enough to be there to kind of coach her along, and grew to several locations. We were involved in helping her to design some of the associate compensation models and retention benefits. And over time, just taking our advice on tweaking and making a few changes in some of the expenses that she had. I mean, I think you would probably agree, Kevin, she just had a profound EBITDA for a practice of her size.
Yeah, it's always fun to work with groups that have like outsized EBITDA because we know it's going to make the buy side go into a frenzy. It was also really nice to have a clean set of financials and a doctor who had always been thinking about building the business to exit and enjoying the cash flows all along the way. So, your client was mind ready, emotionally ready, operationally prepared, and reap the benefit of all that work that she did with you and Brent from 2014 on.
And I think what was great was that, she received an unsolicited offer, and within, she sent the unsolicited offer to us. And, we don't do what you do, Kevin, but at a high level, we report a high level EBITDA every single month. And just taking a look at the offer and our high level EBITDA, I said, I think, this is probably worth, I think her initial offer was was 20 million. I said, this has got to be worth between, 25 to 30 million. You talk to somebody who can, take this into the marketplace and prove that for you. So it really just was really cool to see all of the story and the work put in, validated at the end result, that, the true value of our relationship ended up showing itself on paper just at the conclusion of her career story, really at the point of sale.
Well, we're always excited to get calls from you all on situations like this, and love it when someone has an unsolicited offer, because that is a number we know we can beat. I mean, it's just even highly negotiated unsolicited offers are not the end of the road. So when we were connected with the doctor, we took a look and saw the same thing you and Brent saw. We were lucky enough to take this deal to market and really bring some compelling offers to the table. Had offers as high as 28 million, had one for 27.5 million, close to 40% over her original offer of $20 million. And $20 million is nothing to sneeze at. It was a really nice offer. We just knew that she was leaving money on the table. Ultimately, she decided to go with an offer that was at 25 million because that was the best fit for her culturally. And I think that is critical for everyone to understand. At Tusk, we're going to maximize the value of your practice. We're going to squeeze every buyer for all that they have when it comes to valuation. And then our goal is for you to find the right partner to help facilitate your continued growth. Look, and I know that may be counterintuitive because we're compensated on commission, but ultimately we want our clients to be happy. And she ultimately couldn't have been happier with this transaction. And, over the course of diligence, working with you guys, we were able to turn documents quickly, get the financials that we needed in short order. And what that really did was provided confidence to the buyers, the lenders, and the private equity sponsor that this business had not only succeeded in the past, but was very likely to continue to succeed in the future. So a great win for your client and ours there, Brent and Chris.
Yeah, and Kevin, I'd like to add too, I mean, I think this is a great testament to the long-term value of a doctor really adopting a business mindset. So a lot of times when we get doctors that come to us, they're clinicians and they've never really had the opportunity to be educated on running a business. So Chris and I were able to take them through a process over multi-years and get them really dedicated and focused on building the business itself, the enterprise, and not just doing dentistry. And really, to me, that proved 10 times, 10x value for her upon her exit.
There's a lot that's not taught in dental school that you guys get to teach, isn't there?
There is a lot.
Well, thanks again for this opportunity. It was a great win for all involved, and love to see outcomes like this for your clients.
So Kevin, that was an awesome client to get to collaborate on. And what I thought we would share tonight with everyone is a little bit more kind of behind the curtain of, why financials matter in that end result. That's a great story for us to be able to share with everybody, but there was a lot that went into it. Some of the topics we'll go over tonight. So, when does accounting really matter? How do clean financials help drive that business value and help that sale happen? What's the value in planning your exit proactively? Okay, because there may be some things on the backside like taxes that you may want to plan for. We'll talk about how the sale gets taxed at a high level. And then we'll give a few high-level proactive tax strategies before the sale. And I do want to say that everything we're going to present, here's the disclaimer. Every sale and transaction is unique and structured differently. We thought we would provide some just generic samples at a high level of things that are often or most often involved in most transactions. And hopefully everyone can take away a few things that they need to just investigate for themselves. So I have this saying that, as a non-accountant who worked in dentistry first, I realized very early on in working, especially with doctors, but with all business owners, that accounting never really matters to most business owners until it really matters. And when it really matters is when there's going to be a significant exchange of money. And then all of a sudden, it's extremely important and need to get it done. And it's like putting out a fire to get it done correctly. So it's a lot less painful and a lot more even financially rewarding if you can take a proactive approach on this and understand that as a part of your business, the numbers matter, and they matter really every day. Okay. And so what are some examples of times when you know they're going to matter? Well, every single year you pay taxes and you file a tax return, and that tax return is created by the financials. And if the financials are inaccurate, that can either work in your favor or against you. When you're applying for financing, this is typically the time where we get a lot of phone calls when people are scrambling that they're getting denied for financing because their financials don't jive well with a stranger, an outside third party lender. And that goes the same for anyone who's about to extend you money. We learned for sure that during COVID and all of the disaster relief funds, PPP, that was when accounting mattered the most. It's when all of the record keeping was asked for in order for you to get forgiveness on loans or even to apply for those loans. And so you want to be ready for those emergencies. Take COVID as an experience and a lesson for your business to always be ready to be able to pivot or take action when needed in times of emergency. And then that's going to require you, having your business, financially ready to prove itself. Anytime you're buying a business or if someone is buying your business, they're going to want to see the proof in the details of the money in your financials, and they're going to investigate them. Anytime that you own a business and you're trying to improve profitability, the financials give symptoms to other problems. I like to say that I know enough about practice management of dentistry to be dangerous. That's not my occupation full time, but The financials just give us symptoms to some possible causes within a business, and within the context of dentistry, within a dental practice, there are certain levers, in every business that can be changed. And those financials, again, just give us symptoms like a breadcrumb trail to what some of those possible causes are that need to be investigated further. And you're doing that on your own business throughout time, and you want to think of how you should be doing that on your business. That's how any third party would look at your business on what needs to be changed. And then, of course, at the point of sale, when you're wanting top dollar, top valuation for your life's work, and what you've poured into it, you have to prove to somebody else. I mean, there's the story that you have and what you think it's worth, and all the emotion and blood, sweat, and tears that you poured into it. But you also have to prove the cold, hard facts to a third party stranger that's about to part ways with maybe a significant amount of money to buy your life's work. And if you want that top dollar, the accounting starts to matter big time at that point. So I really challenge everyone. I take the approach of Stephen Covey of always, beginning with the end in mind. And I love this quote because he says, in order to begin with the end in mind, it means you have to start with a clear understanding of your destination. And so I thought tonight, in the stuff we would share, we would share some scenarios, but I want everyone, as you see the scenarios, to look at the end result and ask yourself, what's the end result that I want? And how can I work this math backwards? Okay, so knowing, at what age you want to walk away, knowing for what amount you want to walk away, and working toward that every day, and becoming a student of the game in your financials. And I want you to think of your financials like the X-ray of your business, okay? And constantly getting an updated X-ray and asking yourself, what would you treatment plan, for this business? So it means to know where you're going so that you better understand where you are at now, so that the steps you take are always in the right direction. And I think that quote completely sums up how and why we use financials to help improve a business. Okay, they're a little bit of a compass or a dashboard like you would have it in your vehicle to tell you, what's going on in the business, but you ultimately have to decide on what's the end destination, and then use the financials to help you get there faster and more efficiently. So I thought what I would do is start with a typical sales scenario. And again, I want everyone that's on this call tonight to look at some of the end results and put your number there and try to work this math backwards and put some of the numbers that are specific to you into an equation like this. This first equation we're going to go over is a very generic sale equation. It does not differentiate if you were selling to an individual doctor or to a private equity firm. And I don't go into anything about how you split up the sale. I just at a generic high level want to say, if you have a sale price, what is the net amount left in your pocket? That's going to be very uniquely individual and unique to you. What's that net amount going to be? And so you have to know, first of all, about this confusing tax topic called tax basis. And I think everyone on this call should write this phrase down, tax basis. I'm gonna try to speak to it at a high level, but the reason I want everyone to know, the main thing I want them to know at the end game that's important, this is like the equity, similar to like the equity in your house. Okay, it's the tax equity in your business. It's what you can potentially get out of the sale tax-free. I say potentially because, again, disclaimer, it does depend on how your sale is structured, if it's an asset or stock sale, but just know that tax basis is important to you all while you operate the business. And then it's ultimately can be very, very important to you financially at the point of sale. So you want your tax basis to be as high as possible at the point of sale. So let's just say that the sample that, 500,000 was the tax basis equity there. That comes out tax-free. 4.5 million is taxable. And then there's a negotiated split on the sale of what is going to be, how much is going to be allocated to goodwill and how much is going to be allocated to assets. And so I put in here this generic starting point of negotiation and a lot of transactions is 80% goodwill and 20% assets.
So let me add a little color here. I'll tell you that on our deals, Chris, we're at or below 10% allocated to fixed assets. It's something that is negotiated each time. Buyers will tell you that it's not, but I can promise you that it is.
And Brent, would you echo the same thing? You're involved in a lot of the large deals. You're involved in the tax allocation discussion. Would you speak to that?
Yeah, I would say over the course of the last 12 months, we've seen that 80% number jump to around 90%. I think the highest I've seen is about 91, but it is certainly going in the seller's favor with the current market.
Awesome. So in this sample scenario here, that 80% goodwill taxed at the highest rate of capital gains, 20% currently, generates $720,000 of tax, and the 20% assets tax at ordinary income. It all depends on where your total income for that year falls, but I put it here 35% in ordinary income rate, $315,000. We have a total tax of just over $1 million. So you had your sale for $5 million. You had taxes of just over $1 million. You received just under $4 million after tax. And I think a lot of times this is, the basis conversation never comes up, but I think a lot of times people kind of walk this far through the calculation. And there's one other piece that they forget. And that is that if you have any debt in the business, all debt gets paid off with after-tax dollars. Okay. And all of your loans in the terms of those loans, most of your lenders have first lien position on your practice asset. So when it's sold, they get paid first, but that is all with after-tax dollars. So then you have a net proceeds. And this is the generic, again, high-end equation. I think everyone needs to take what they want their net proceeds to be. Okay. They need to subtract out the debt that they have today in the business, and that give them an after-tax number. And I'd take that after-tax number and basically add in, another roughly 25% to it. You just work this entire equation backwards. Okay.
I'm so glad you're showing this. All too often we get phone calls from folks, Chris, they say, look, I want 10X on my deal. And I'm like, first of all, 10X on what? Then like what is your debt? I mean, we've looked with some groups, even like an 8X deal after debt, taxes, and fees, they're putting money into the deal. So managing balance sheet, paying off taxes, tracking basis, this is all critical because it matters, but it doesn't matter what you get from an enterprise value perspective. What matters is the net proceeds to you and your estate.
That's right. And I think I would echo exactly what you said. I think everybody likes to speak, in a very fancy manner, talking about the multiple. I want to get my 7X, 8X, 10X multiple. And we can certainly be guided on how you can get that multiple. And the question is, after you get the multiple, did you end with that? What multiple did you end with? I think we're all too often enamored by what it takes to grow, and you do need to remember that depending on how you grew, if you took on a lot of debt to grow, that has to be cleared out, and that's part of the equation. So these are the two main takeaways. I just want everybody to screenshot or commit to your memory, write down, get to know your tax basis, talk to your CPA. You probably have never had that conversation. I'm going to show you here in just a second. It's in everyone's tax returns, or at least in the tax software. It's not always given to you in your tax return because there are different copies of the returns, client copies and CPA copies and IRS copies. But get to know your tax basis. It's a good health indicator. You should want it to be positive, and you should want it to be very high. And what is your strategy to get out from under all of this debt? Are you really waiting for the bailout of the sale to get you out from under this debt? Because that could make it so that you don't have a very much left over at the end that you net from the sale, but have a strategy depending on your time frame to get the debt paid down.
So I know we're keeping this very high level. I think it'd be important just to give some context on the transactions that are going to the DSOs. So the main variance in these deals is typically there are going to be multiple components of that sale price. So typically, we'll see the seller receives a cash payment at closing. There is an opportunity, I think, in every deal, almost every deal, to roll over some of that purchase price into some equity, which that actually will get deferred for tax purposes into a future year. There's typically some indemnification escrows and maybe some holdbacks. So there is a little bit of a different nuance to the DSO side that does offer some deferral of some of the purchase price. And Kevin, I don't know if you want to maybe just tell me real briefly kind of on the breakout you're seeing on the cash at closing versus some of the earnouts and things.
Yeah, I would just say every buyer is different. Some are very, very proud of their equity, and they will only offer up to a certain percentage of total enterprise value, whereas other DSOs will say, we are elated to have you roll equity, but you must roll a minimum of 20, but you can roll up to 49%. So it's a wide range, but all but one buyer that we work with requires some portion of the proceed to be rolled into equity.
Okay. Brent, I'm really going to want you to chime in on these next few slides talking about tax basis. What we're gonna go through is another real life example of a client of ours who sold a few years ago that was not such a pretty story, that had no tax basis, that had a lot of debt, that had a lot of tax deductions they weren't able to take advantage of before the sale, and kind of sold out of desperation. And that's a situation you don't want to be in. So at a high level, tax basis, again, it's kind of this, I call it dentistry's nasty hidden problem that really only gets discovered at sale. And typically it's still never even explained to the owner, and they're not educated enough on it to understand why they didn't get more money at the point of sale. It is your equity. That's what I want you to take away. Basis is tax equity value. Okay. And in most cases around the country, most dental practices are S corps. Excluding states that don't recognize S corps, I would still say 80 to 90% of who we interact with end up being S corps. And in the S corp especially, basis dictates the rules for you to be able to take advantage of that S corp. Most people don't realize this first one. If you don't have tax basis, you can't take depreciation on equipment. Equipment reps will tell you that the tax code under Section 179 will allow for up to $1 million a year of depreciation. And that's true as Part A of the sentence. But Part B is you can only depreciate against the basis that your business has. So if you're thinking of buying an $80,000 cone beam and you have a basis of $20,000, you only get to write off the $20,000 and you can carry forward the difference. Next is, the biggest reason to be the S corp is to be allowed to take distributions. Well, distributions can be a beautiful thing to save you money on your FICA taxes, Medicare and Social Security, but there are rules around it. You're not just entitled to take distributions nonstop. So tax code says if you zero out your basis and you take distributions in excess of basis, you're supposed to get penalized and pay an extra capital gains tax on those distributions, an extra 20% penalty, if you think of it that way. And that is something that a lot of CPAs don't like to deliver bad news at the end of the year as a surprise. And so it can get swept under the rug and put somewhere else. And a lot of times people don't know that other somewhere else there is. I'm going to uncover that right now for you tonight. The third way is if you do have losses. Typically, if you have a loss, you can deduct it. That's, again, only if you have basis to deduct against. So hopefully everyone that's on this call that is trying to grow their practice profitability and EBITDA and their total valuation, we don't even have to worry about the losses on this call. So basis, I said earlier, is the amount that you get out of the sale tax-free. And we have that equation of the sale price minus your basis is the taxable proceeds. I will tell you that most smaller practices, especially your practices that a lot of the older doctors out there that we encounter have little to no basis. So again, this is something I want you to look at and then determine how that fits into your glide plane of your point of sale. What I want you to be aware of and go back and investigate, and we'll show you next on your tax return where to find it, is a line item called loan to shareholder. Technically, in accounting terms, basis cannot go below zero, but this is the place where accountants will sweep it under the rug and do a journal entry and record a loan to shareholder. And there are rules with that. Brent, why don't you go over the tax return that we're sharing on the screen?
Thanks, Chris. So this is actually an excerpt from an actual tax return, and stock basis is simply a mathematical computation. As CPAs, we track this for our doctor owners every single year. So you begin with your beginning basis. So in this case, line 1 is 0. Basis really goes up in two main ways that the doctors on this call will relate to. And that is either injecting personal cash, which is a capital contribution, or profits. So look, we're all in the business of growing the value of our enterprise. And the fastest way to do that is driving profits. So once you take into account those increases, we then look at all of the decreases. So things such as entertainment expenses. Prior to last year, business meals were only 50% deductible. Those things still reduce your stock basis. In this case, the doctor on line 15 had an ordinary operating loss, so that reduced his basis. And then ultimately, at the end of the day for this doctor, because he was not paying attention to his business, he accumulated over $700,000, multiple years of losses that he was not able to take advantage of on his personal tax return. So at the end of the day, he's still left with zero basis. And, Chris made a comment earlier, one of the unfortunate situations is, when a doctor comes to us and they have these large losses that are accumulating, I can assure you at the point of sale, it is a question that comes out during due diligence. The group buyer will ask questions about why the shareholder loan is there, and it ultimately has to be corrected.
And I think the point I want to leave everyone with too is this is still fixable. And this is conversations that somebody like, Kevin will have with you as is it the right time for you to make this decision? What time frame is the right time? And kind of collaborating together and saying, if this fits with your desires, your end goal, the amount that you want, this is fixable. Not to say it doesn't take work, but the sooner you can get ahead on it when you're not under huge pressure, the better. So we wanted to show kind of the spectrum of an incredible scenario that we started out this evening's call with Kevin, where the doctor had an incredible basis. They paid off all their debt and got a great, just a great end result in their sale price. And then there's a situation like this, and we work with scenarios, all of us on this call, I think, work with scenarios everywhere in between. But it's definitely fixable, something just to start getting educated about. On this shareholder basis computation, it is included in your business tax return, at least one form of it. And if you don't see it in your return, just ask your CPA for a copy of it. Brent, will you talk about the loan to shareholders line item?
Yeah, so this page here is essentially, it should replicate your balance sheet from your financials. And on line 7 here, you can see what has happened is because this doctor had multiple years of not being very business focused. So these losses were accumulating, but he was still taking distributions out of the business. Like Chris said earlier, it's not just an open checkbook. You really have to monitor your position every single year. So at the end of the year, as a CPA myself, I can tell you, if this is not tracked, it's a very uncomfortable conversation to have to go to a doctor and say, look, doctor, we're doing your tax return right now, and we just realized that you took out $400,000 too much money in distributions. So we have one of two choices. You can pay an additional 20% capital gains tax, just $80,000 plus your state tax rate, or we can make an accounting entry and just call it a loan. That's perfectly okay as long as you have a documented promissory note, you have a payment plan, because if you were to go under audit, those are things the IRS is going to ask for promissory notes to see that you're treating it as a real loan.
Brent, how many clients or prospects have you come across that have that in place as a percentage? Just take a guess.
Well, I've done 5 consults this week, so I'd say I'm shooting about 85% right now.
That have a loan to shareholder balance.
Yes, well, I guess it'd be 80%, 4 out of the 5.
And what would you say as a percentage, how many of them actually have a loan document or even knew that it existed there?
0.
Yeah.
Yeah. And this is the scary part. So this is kind of like unearthing the details, and this is boring, it's not exciting. It doesn't matter until it matters. And that's when there's an exchange of money. Okay. Last thing I want you to say on this, Brent, what would happen during an audit?
So Kevin, you can play with me here. So typically, Kevin, let's say that you're the owner of this business. So we're sitting down at the table, and I would say, Mr. Cumbus, I noticed here in your financial statements that you borrowed $393,000 from the business. Could I see a copy of your promissory or loan document? And your answer would typically be,
I don't have one. Yeah, no, I don't have one.
okay. Well, Mr. Cumbus, that's okay. Let me see a schedule of the payments you've made. Can you pull that out for me?
No, I don't have that.
Okay, well, Mr. Cumbus, I understand you've shown this as a loan here, but really what I see this as is disguised wages or shareholder distributions. So we're going to go ahead and reclassify this to, let's say, wages, for example, and I'll send you a bill for the FICA and Medicare and the interest and penalties for the last X years.
Yeah.
That is typically how a conversation would go. And I'm not saying that to scare anybody. It's just, Chris and I do feel it's very important to have an understanding, have documentation, but have a plan to fix it, because it is very fixable.
Okay.
Great.
So how do you fix it? I'm sure that's what everyone's knowing. Like, how does basis happen? How does it get created? So we give a real simple equation here. So basis started when you started your business or bought your business. It ended last year on December 31st, and it started again on January 1st this year. It's an ongoing equation. It's a closed loop system. It continues to go on. Every year, the two ways it can go up are either if you add assets to the business, which is typically more rare. The primary way is profit. Everything that Kevin and his team would educate you about on EBITDA, it's all in line with the same thing. The value is all in profit. The value for the person buying your business and the value for you in selling your business is going to be in profit, both from the valuation standpoint and the sale price, and from the amount that you get out tax-free because of your basis. So profit drives it up. Distributions bring it back down. If there was a loss, that would bring it back down. Any depreciation is subtracted from it. And then you have an ending basis. And this happens every single year. And so you just want to see, there's going to be years that you reinvest in your business and your basis may go down. That's okay if you know why you're reinvesting to buy equipment, and you know what time frame you have before you're going to exit your business. But you want to be aware of where it's at, and your goal should be to trend upward and to make it as high as possible at the point of sale. Okay. How do you do that? How do you become more profitable? Well, unfortunately, this is what most of the industry sees in financials. This is the majority, this is a sample of what comes across our desk in a new consult, a very lazy alphabetical printout of financials that takes some time to sift through and determine if it's a healthy business or not. It's not just about the bottom line. Bottom line is very important, but it's about what metrics can be leveraged and changed to affect an even better outcome, even more profitability. So it is better to have a very clean, consolidated financial statement that has a chart of accounts, groupings that matter, okay, that you can make changes to affect change in your business. And this is more of what we like to present, okay? We like to have every business bank ready at all times like this. And it can be a summary version, it can be a detailed version. And why does it matter that it's this clean too? Because you can also very quickly point out other things that may matter and differ. So 2020 and 2021 were unique years, and that there was a lot of extra cash that came into a lot of businesses. I think this part of the story that gets left out in their interactions with their accountants, patting them on the back, look how profitable we are this year. But that was not real. Okay, that was new money that came in, and that got wiped off the P&L by the time you file your taxes because it got forgiven. But for a lot of people, that was on their P&L, and they were just thinking, oh, I've never been this great. Well, you just want to make sure, do you have the real number? Having ready at your disposal to show someone the last 3 years of your business is vitally important. It's always been the case. The last 3 years are some of the most important years of what's used in the old traditional ways of valuation, showing someone a track record, a story of growth and even of rebound, through COVID. So you see on the screen 2019, 2020, and 2021. Again, looking at the outliers of what was different in those years and how net income was affected. So net income is just one of the small factors that goes into the calculation of EBITDA.
Hey, Chris, let me add something here real quickly.
Sure.
You're talking about 3-year look back, and I think all too often, I'm guilty of this, talking about exclusively trailing 12-month EBITDA. Yeah, that is certainly the starting point for valuation, but it is only one stitch in time. Buyers are certainly going to look back a year or two or more to see the trends, right? They want to know where the business is going based on the historical performance. So shame on me talking probably too much about just the trailing 12 months. Every year leading up to your exit matters, and getting that trend line going up and to the right drives higher valuation.
Yeah, and being able to tell a story behind those numbers of why was one year better than the other. But I'm going to give you your shining moment, Kevin, on the trailing 12 months. We have
Here
that.
we go. This is it. It's what I've been waiting for.
So we in every single month's financials that are delivered by the 15th of the month to every client, or they're free. That's our company guarantee. And every single month they have all of these reports in their financials. And the trailing 12-month report was one that, as we were, building this company out of my own frustrations while working in a practice, I did some consulting with a couple smaller DSOs, with some of the larger traditional lenders like Bank of America, and some practice brokers. And I was asking all three of those, what do you wish you saw in financials? And one of the consistencies amongst all three was trailing 12 months, Kevin. So don't give up that is still vitally important, but we overlaid that with the trailing 3 years as well. Why does the trailing 12 months matter? Well, I really think it shows outliers as they happen, and how they can affect the results throughout the year. We talk to on our coaching calls with clients, we talk to them about what are their strongest months out of the year, what are their weakest months out of the year, and why they think that is. Mm-hmm. It's our goal to give them recommendations to even those out, so they don't have huge swings in the month, so they have more consistency in revenue. And a lot of that has to do with their strategic investment into marketing, as an example. So I've circled this, they had a bigger investment in this month here in marketing, that those results typically don't show up until 3 or 4 months later. So you see in the May, June, July, you see the numbers start to go up. Yeah. And then questions about, why did your team expense go up? Who did you hire? How did that affect or improve, your overall collections? And do you feel like they were efficient? Did that improve, profitability? So it's the numbers, again, are just symptoms, and the key is questioning and asking why, and what, how can you see those changes happen? So really, it's more than just the numbers. You have to be able to back it up with the story.
Okay? One thing to add here is, we're hearing from the buy side. So the trailing 12-month is that story. But if you add a full-time, just looking at this data set here, January through December of 2021, if you added a new full-time hygienist to a tune of $50,000 annually in December, let's say you added them in June, they're going to want to think about what the pro forma total cost of that employee is on a go-forward run rate basis. And what some buyers are going to want to do is burden your EBITDA with a full year salary of that hygienist. And what they're not going to want to do is give you the full benefit of that hygienist over the course of that same year. So sometimes we see buyers want to pro forma the expenses without pro forming the revenue that comes along with those expenses. So you kind of got to keep your ears up when talking with buyers about what they're looking to add as burden to EBITDA, and not having the accompanying benefit that comes along with that investment inside of your business.
Right. And then, why were these numbers higher in these 2 months here on team expense? Turns out, this client likes to try to incentivize their team and pay a quarterly incentive or bonus. And especially at the end of the year, they look for different things that they're trying to just reduce taxable income. And so some of it is strategic. If it wasn't a mistake, it wasn't there's a story behind why it's strategic that they did it, then I think, that can be considered something to add back. So I can't say enough how I think the story matters, even behind the numbers. And then the other thing we do is we combine those two and we try to show any third party, give them a visual of how the practice has performed month by month over the last 3 years, okay, as a comparison. And especially with the COVID year in the middle there, blue, showing the rebound effect. And that was vitally important to lenders. It was vitally important to investors. There was that brief blip or pause where lending was on hold and investors were kind of holding their breath, and then things resumed. But this was a huge benefit during that time period to give those third parties confidence in these businesses. So, and then I'll like to sum it up with another version of the sales scenario, but it may be a little bit more in depth. And I'd love for Brent and Kevin, maybe the two of you can even kind of tag team this together.
Well, I'll start by saying this clearly is not my slide, because we would never trade $750,000 for 6 times. But that aside, what we're looking at here is a valuation based off of EBITDA of 750,000 times 6 gets you to $4.5 million. Then there's an allocation of the purchase price between 2 buckets. One is cash, that's the cash at closing, and the second bucket is stock in the DSO. In this example, the proceeds, the valuation of $4.5 million has been allocated 75% to cash and 25% to stock in the DSO. Now comes the accounting part of the equation. So I'm going to let Brent take over from here.
Yeah. So in this scenario, Kevin, so the cash at closing, because taxpayers are paying taxes on a cash basis, off the cash at closing after the reduction of their tax basis, they've got 2.875 million taxable. In this example, there's an 80-20 split between goodwill and asset allocation. So on that 2.8 million, they paid about $660,000 to Uncle Sam, which left them with after-tax dollars of about 2.2 million. And as Chris mentioned earlier, then comes the debt payoff. You have to pay off the debt when you close a transaction. So they actually walked away at the end of the day with about 1.5 million cash in their pocket. On the right side of the column is really where the rollover into equity or stock in the DSO comes into play. So the $1.125 million that they rolled over is not immediately taxable to them. So that money is considered the basis in their new stock position. Mm-hmm. So once the DSO recaps or turns, typically I think it's a 3 to 5 year goal of a turn, Kevin.
Yeah, that's right.
So let's say that stock is now worth $4.5 million. So when you look at the tax implication, you've got the $4.5 million of the current value of that stock. Again, we reduce that sale price by the tax basis of $1.1 million. So they will now pay tax on $3.375 million. The good thing is the equity or the sale of its stock or the turn is taxed at capital gains rates. So at 20% rate, they're going to pay about $675,000 of taxes. So their net position is right at 2.7 million.
I love this example. I think the one thing we should certainly point out here is the 4 times cash on cash return is it's going to be predicated on when you get into the investment and how successful the DSO is. But even at 3 times cash on cash return in your example here, this seller is going to earn as much or more on the equity roll on a net basis than they've done the cash portion. And really that's why there is, a lot of times eagerness on our client side to roll 30-40% of the proceeds into equity rather than take it at cash and be burdened by the ordinary income taxes and the immediate long-term capital gains rates here that you're showing at $661,000 of taxes in the cash column.
Right. And Kevin, I think too, this is where, from my perspective, I think this is where you bring the value to the table in choosing the right buyer, because you know all the DSOs, you know their historical performances on, accomplishing what they've laid out as their plans on recaps. So maybe a plug to you, but the value you bring in helping the doctors pick the right partner is priceless to me.
We just tell them the truth, right? Exactly what we would do if it were our money, if it were our investment opportunity. And the great thing about the market is if we're working with a client who is risk averse and wants to see that $1.1 million of stock in this example turned into cash as soon as possible and is less concerned about the return on invested capital, we've got a buyer for that doctor. If there's another doctor who is set with his or her retirement plans and has reached financial independence and views this as a great investment vehicle, we can introduce them to buyers that probably have a longer hold time. And with a longer hold time, you're going to have more time for that investment to season and earn a higher rate of return. It's so great to be in a space where there are this many opportunities to meet client needs.
Absolutely.
So once again, I would say everyone on this call should use this as an example as well and try to plug their numbers, their ideal numbers at the bottom there, work backwards. And somebody like Kevin Cumbus and his associates at Tusk, they work the numbers at the top for you. So you're in charge of your EBITDA. They are in charge of helping you get that right multiplier and helping you negotiate that split between the value and negotiate that split between the goodwill and assets. And all the other stuff kind of there at the bottom that the accounting team on our end does is kind of, in there in the code. So that's typically a lot of times for most people, even if it's a great scenario, this is kind of the end story here. So what I want to do next is talk about what I wish we saw more often, which is proactive planning for that sale and what happens with the proceeds. If you have a glide plane of time before you sell, it's worth talking to your accounting team and your legal team on if any of these strategies would benefit you in the right time frame to avoid taxation. So if you put a DSO entity in place before you sell to a private equity firm, and that DSO entity has, let's say, your family members in it, whether that be a spouse or your kids, when you're transferring or gifting shares of an entity into that DSO, any members in there get a step up in basis. So that means they already have a new higher basis or tax-free amount that they would get out of the sale. So that can very positively influence taxes owed at the point of sale. There are trusts that you can have in place when the transaction is initiated to have the proceeds go directly into those trusts, or some of them you move shares of the business into those trusts in advance. An example of this is a charitable remainder trust. It is a complex planning matter that involves both the CPA and an attorney, and to make sure that you move assets without triggering any unnecessary taxes. But it can significantly shelter the amount that you'll get taxed on. And then one of my favorites is thinking about, I like to use the word parlay, thinking about how you would parlay the money. If you're going to get a lump sum of money, would you then just, put it into savings or the stock market? How would you get that money to work for you? And one of the best ways out there is, passive income, passive rental income. And there are a lot of tax benefits that come with ownership in commercial real estate. So you may or may not own your own dental practice building, and that's one form of this. But think about what other commercial real estate, what other businesses you could own that you could parlay in the same calendar year to offset taxation. Okay, and that's an important thing, just to think about where you are in the calendar year at the point of sale. Have these things lined up. So we'd love to invite more conversations around this and have discussions with anyone listening on this call and go more in depth. But at a high level, those are three large things I think you should consider and investigate. Lastly, I thought I would give a 1 year, 3 year, 5 year, and 8 year glide plane. So wherever you are in your life scenario, if you're attempting to sell your business this year, or you're within a year of selling, here's some things you should consider. There's no value in you buying assets and updating all the equipment in this year. That depreciation is going to lower the tax basis, and you're not going to recoup that amount in your valuation, because EBITDA by definition excludes assets. So I would try to clean up the financials, remove any personal expenses that you can from the business, and show as much profit as possible on the highest revenue possible in your last year. And then if you're nearing that point of sale, it's probably worthwhile as a project to get your financials scrubbed and put in a very nice presentation format to present and tell your story of your business. If you have a little more time and you got 3 years, it's a great glide plane, because as we said earlier, the last 3 years of collections and profit will matter the most. And there's plenty of time in that 3-year period to significantly increase EBITDA. I would say as a percentage of EBITDA, most of our clients come to us and they're maybe in the teens or 20s, as 20% of their collections is their EBITDA. And after a solid 2 years of implementing advice and managing cash flow, we approach 40% of EBITDA. And it does take time, but a 3-year glide plane is an excellent time frame to do that, which will also reestablish your tax basis and clean up those shareholder loans. So that great time frame there to get everything set up with all your legal documents, as well with the trusts and potential DSO entities. 5 years from sale, that's a great time glide plane to pay off remaining debts. We do analyze the cash flow of if that's the right thing to do. How will it affect your cash flow, and what are your future considerations in that 5-year time frame? It's also a good time frame to be able to purchase commercial real estate and pay off a good majority of it, and pay off the rest of it with the sale of the business, and be left over with rental income from your office building, because these DSOs and private equity firms typically don't want to buy your real estate. It's important to lock in your associate compensation retention plan so that you can have that 5 and 3 year track record of growth to show. And if you have 8 years or more from the sale, I always tell people, if it's out there and it's long term for you, whatever date you have in your mind that you want to completely walk away from dentistry, subtract 3 years. Try to give your advisors like Tusk and like us 3 years to get you the best outcome. Don't wait until that date to say, I'm ready to sell now. Let's do the work that's involved, because you will not walk away with the largest amount of money or the best outcome. Still plenty of time there to buy real estate, add another location, add or train doctors, pay off debt. We love working with clients that have a long-term goal and plan.
That's awesome stuff. I'll just say, when we've worked with clients that have prepared through you, they have their house in order. These transactions are kind of like three-legged stools. You have to be financially prepared. And that's really what this is about. You have to be operationally ready, meaning most of our deals are going to involve the doctor, if the doctor is providing clinical care, to work post-sale. To maximize the value of your business, you need to work at least 2 years if you're a general dentist, and many times 5 years if you're a specialist, to maximize the value. And then also there's the emotional leg of the stool. As you're plotting towards this timeline and saying, at this point I'm ready to sell, you don't have to sell at that point, but you will be operationally, financially, emotionally prepared. And then you can come into the transaction negotiating from a different headspace. And that leads to higher valuation as well. So all great points here. Love the exit plan timeline.
Awesome.
So as I look at things, I know we're running out of time here. When you look at the tax code, everybody thinks that there's a magic pill, a magic bullet that just makes taxes go away. The tax code really rewards you the most when you make big moves, doing something in a business that improves the economy. Typically, it also involves real estate. So your business is your greatest tax shelter. And as you're thinking about this exit plan, you also need to think about how you can fund the next business, because once you finish your life in dentistry, how can you then parlay that money and shelter some of the income in retirement?
Brent was the one that would say this all the time, and it finally, really clicked and resonated. Just because you're going to walk away from your current business or the profession of dentistry doesn't mean you have to walk away from business altogether. And that doesn't mean you have to be in a business that involves a ton of people. I think you should, if you have a good time frame, you talk about the high level, high value tax planning and strategizing. It involves talking about what can you do beyond the sale of this business in preparation for that sale, so that you can, get the majority of this money in your pocket so that you avoid taxes. But you do have to be strategic about it. And I think people are looking for quick fixes, and there are a lot of schemes out there, so you got to be careful. But with the right strategy, your net picture after taxes and all of that can be a lot better if you line things up proactively.
Awesome. Guys, I know we had hopefully set aside some time for questions. I think the content that was delivered tonight was critical. We are out of time on the Q&A, but for those of you who did submit questions this evening, we'll funnel them to the appropriate party, either over the profile or here at Tusk, and we will get you an email response and set up a phone call if necessary. Gentlemen, thank you. I learn every time. I get on the phone with you, exchange texts with you at 5:30 in the morning or 11 o'clock at night. So thanks again for making this informative. I know our audience enjoyed it. Lots to learn, lots of planning. And again, the key is to keep as much as possible in the sale of your business. So thank you both for your time this evening. You can find contact information for both Chris and Brent on their website. There it is. And thank you again. And I'm sure I'll see you out on the road. It is conference season, so I know we'll be out there soon and enjoying a meal together here shortly.
You got it. Thanks so much, Kevin. It was an honor and a pleasure.
Thank you, Kevin.
Thank you all. Good night, everyone.
Good evening.